Welcome to this lecture on the fundamentals of the stock market. In this lecture, we're talking about understanding the risks and potential returns of investing in the stock market. Suppose you had just turned 67 years old at the end of 2012 and had just retired. You had saved for retirement starting at the age of 40 until you retired on your 67th birthday, having invested all of your contributions in the stock market and reinvested all the dividends. How well would you have done? Well, if you began this saving with your first contributions in 1986 at the end of your first year of work under the retirement plan, and let's assume a starting income of $50,000, inflation of 2%, a real salary growth rate of 1%, and a contribution each year of 10% of your income, you would have ended up with $592,000 in your account at the end of 2012. Not bad for having not started to save until age 40, although you did have to save 10% of your income. Now, what if instead you had been a few years older and had started this with your first contribution, again at age 40, in 1983 instead of 1986? Your 67th birthday would have occurred at the trough of the stock market in February 2009. If you retired at that point, you would have ended up with around $429,000, or around 28% less than if you had started 3 years later. Now, with the benefit of hindsight, it's clear that investors who hung in there with the stock market in February 2009 and kept their stocks rather than selling them saw their balances recover. But at the time, there was great concern about the stock market. When an investor gets into the situation of having just seen a little less than half his retirement wealth evaporate in the span of a year, it's difficult to know what to do. If there is really mean reversion in the stock market, meaning that extreme increases and extreme decreases will level out over time, then you should just hang in there through the downturns and sell off slowly during big booms. But this is a very difficult path to force oneself to follow. Specifically, when everyone else is making money in the stock market, it's hard to force yourself to sell out of it. And when everyone is losing money in the stock market, it's hard to stick with stocks or buy more. And more importantly, we don't really know whether the stock market really does mean revert. We don't know that in all cases after the market falls it'll rebound. We have only one history of the stock market in the US. And if we look around the globe, we can find examples of countries whose stock markets really never recovered or took a very, very long time to recover. Here, for example, is a graph of the Japanese stock market, the Nikkei 225. It got to almost 40,000 points in 1989. It then fell to below 10,000 points. That's a 75% decline. By April 2014, it had recovered to around 14,500. But this is very far from the high of almost 40,000 points at the end of 1989. In this lecture, we'll make some progress towards understanding the stock market. Many individuals and institutional investors invest in stocks, deciding that they like the risk-return trade-off that they perceive in the stock market. For example, consider 401k plans, the leading retirement savings vehicle for private sector workers in the US, with over $3 trillion worth of assets. At least 44% of 401k assets owned by participants in their 20s is invested in stocks, and 41% of the assets for participants in their 60s is invested in stocks. Those figures do not include other types of retirement account investments, such as target date funds and balanced funds, which also include equities. Furthermore, many individuals own some stock outside their retirement accounts. And then there are the large pension funds that manage trillions of dollars of money. They provide pensions to government employees and the older employees of firms in more traditional industries. These have also chosen to invest in the stock market. At the end of 2012, state and local governments had around $3 trillion in US-based pension funds as well, with around $1.8 trillion in corporate stocks. The stock market consists of the traded equity stakes in all publicly traded companies. In this lecture, I won't be talking too much about individual stocks, but rather about the stock market as a whole. One of the major principles that you learn if you study individual stocks is that there are substantial benefits to diversification. Diversification is the combination of the stocks of many different companies into a portfolio. What we are covering in this lecture is how financial economists generally think about valuations in the stock market as a whole. Financial economics views the stock market as it views any other asset. There are many different states of the world, whether the economy is good or bad, whether natural resources are cheap or expensive, whether inflation is high or low, and an asset is characterized by its performance in those different states of the world. Historically, stocks have had a higher return than risk-free assets, but that higher return is not guaranteed, and the lack of the guarantee the fact that the stock market can generate much lower returns than the risk-free asset in some states of the world, is what makes it possible that the stock market can potentially deliver higher returns than the risk-free rate in other states of the world.